Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, April 20th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are down this morning. We've got the Dow futures down 170 points, S&P 500 futures down 30, NASDAQ futures down about 129. On a percentage basis, NASDAQ futures down almost 1%, clearly taking a little bit of the brunt of the selling this morning. Crude oil prices down $1.19. We're back below $78 a barrel. 10-year Treasury yield is down 4 basis points, back to 3.56%. Oh, we got a lot in store for today. It is option expiration week, so pretty much anything goes. I like to call it opposite George week. And I'll talk a little bit about more about that in just a bit. But today we'll go through the daily market recap, talking technically, chart of the day. Got questions for Tom. A number of Earnings Beats members have sent in some questions. I want to go through some of those. Then the earnings spotlight, and we will wrap up with the 3 you must see. But let's go ahead and jump into the daily market recap and see what happened on Wednesday. So we had the Dow Jones Industrial Average finish down almost 80 points, S&P 500 about flat, down 0.35. NASDAQ finished higher by 4 points. So really not a whole lot in terms of percentage gains, losses, but it was bifurcated action. Mid caps up about 0.2%, small caps up 0.3%, a little bit of relative strength in the mids and smalls. Looking at the sectors, utilities up almost 0.8%, real estate up 0.6%, healthcare, that's up 0.3%, and financials up almost 0.1%. The leaders, defensive, value, that's what you should take away from yesterday's action. On the flip side, the big loser yesterday, the hottest sector of the year, communication services, down about 0.75%. And that is not too unusual as we head toward options expiration Friday. The 10-year Treasury yield. Well, we have a few economic reports coming out later this morning. Initial jobless claims will be out at 8:30. Of course, by the time you get this recording, they will already be out. But initial jobless claims expected to jump to 242,000. Last week was 239,000. We have been seeing those initial jobless claims rising over the last several weeks. I think that's an indication we're seeing a little bit of a slowdown in the economy. April Philadelphia Fed Manufacturing Index is expected to come in at minus 19.4. It's a bad number, but it's an improvement over March, where we had dropped, where we were minus 23.2. Then we got March existing home sales. That's expected to come in at 4.5 million units. February was just slightly above that at 4.580. So a little bit of a drop in existing home sales expected. And then March leading indicators expected to decrease to minus 0.4% from February's level of minus 0.3%. So all in all, it looks like, economic news not expected to be great today. We'll see how that turns out and what kind of impact that has on both stocks and bonds. But looking at the 10-year Treasury yield, we did jump up yesterday into the 360s, but we finished pretty much on the low of the day, 3.6%. And now we're down another 4 basis points today, 3.56. If you look across here, I'll annotate this for you real quick. You can see that the yield resistance for the last few months, last month, has been right at about 3.65. Yesterday's high, 3.64. I mean, we're right up against these prior highs. There's also this little bit of gap resistance right there where we had gapped down from. And you can see intraday, we haven't been able to get back through that, certainly not on a closing basis. So I think 3.65, 3.7 is your short-term area of resistance on the 10-year Treasury yield. To the downside, if you're trending up, you would look for that 20-day moving average to hold. That's currently at 3.51%. So from yesterday's close, we're about halfway on our way down to that, down 4 basis points today. All right, so not really a whole lot else to talk about here with the 10-year Treasury yield. We've seen a lot of the ups and the downs here with the yield. So I don't really think there's a whole lot going on here on this chart. I think longer term, if we pulled up a weekly, we'd see, well, we can pull up a weekly. We're going to see more of an uptrend in place right here. I think that's pretty clear. That's an uptrend. If you look more intermediate term, last 6-8 months, more to the downside. And then short term right here, we're starting to turn back up again. So we got short term up, intermediate term slightly lower, and then longer term clearly up. And so the question is, and looking at this chart, it's always good to have longer term perspective. But right there at about 330, 335, we made that breakout back in September of 2022. And we've gone back and kind of tested this area, but another low would really start to paint a more significant intermediate term downtrend in the yields. Just because at that point we'll be below the 50-day, which we haven't really trended much below the 50-day over the last 3 years. And the PPO on another move lower would probably turn negative. And we did that very slightly here back in the middle of 2021. But for the most part, during the uptrend, we've seen the PPO positive and we've seen the yield above the 50-day moving average. So if we do move down to one more low, right now, this slight breach of the 50 looks a little bit like this slight breach of the 50 before we went higher. So I think those of you who are bearish, I think that's what you'd be looking for here, this support level to hold and eventually see the 10-year Treasury yield move back up and break above the October high from last year. If you're in the bearish camp, that's what I think you need to be banking on. Lower interest rates going to increase valuations. So you need the rates to head back to the upside. I think that would certainly spook the market. I don't see it, but I'm watching it to see if it happens. We want to be always alert for both sides of what's going on. But right now I think we're going to continue to trend lower. I think inflation becomes less of a problem. The economy slows. I think the Fed will lower rates by the end of the year, or at least be talking about it. But I think they could lower before the end of the year. I know they're not projected to lower rates until sometime in 2024. I wouldn't be surprised if they lower at the end of this year. Once their job is done on inflation, they can turn their attention. All right. Let's see. Let's move on to talking technically. So let's look at the S&P 500. Not really a whole lot been going on. I mean, we're up a little bit this week on the S&P, but we do have overhead resistance right here at 41. Closing resistance is at 41.79, and we're 25 points from there. So less than 1%, a little bit more than 0.5%. I don't think this week we're breaking through that number just because it's option expiration week. A lot of in-the-money calls as a result of this move up in the S&P. So I think the fact that we're pulling back, that's one of the things I've been talking to our members about this week. Don't be shocked by a short-term selling episode, because Max Payne would certainly suggest it. There's a lot of in-the-money calls as we head toward option expiration tomorrow. And then, of course, anybody who exercises their in-the-money call options, they get their stock going into next week. Market makers are on the other side of that. They're shorting still. So you can still see some of the effects from options expiration week going into the following week. So I think the next 2 to 4 or 5 days, I'd be more surprised, I think, by a breakout than I would on a pullback to the 20-day, just in the short term. The NASDAQ 100, you can see that black candle yesterday. I think we're in a downtrend. We're going to get a gap down today, probably below yesterday's candle, it looks like. So, yeah, I think we're getting to the 20-day. I would not be shocked if we see a pullback to the 50-day. A little bit more maybe than the S&P 500. Why? Because this group has run more. We've already cleared the February high. You got a lot more in the money call premium on some of the aggressive areas represented on the NASDAQ 100, more so than on the S&P 500. So I think this is the area that could be impacted a little bit more. And I'm going to talk to you a little bit more about this in just a second when we do the chart of the day. But before we go into the chart of the day, I do want to let everyone know that over at Earnings Beats, we do have a Earnings Beats Digest newsletter where we feature a chart once, 3 times a week. So Mondays, Wednesdays, Fridays. So if you go over to Earnings Beats, both plural, earningsbeats.com, you can sign up for our no-cost trial to our paid service, get 30 days for free if you want to try that. But if you scroll down, you want to learn a little bit more about what we do, how we approach the market, what we look for in trades, maybe some educational material like sentiment. We get into sentiment. We talk about seasonal patterns, historical trends, a lot of earnings, gaps as a result of earnings. You'll see a lot of that featured. Anyhow, if you scroll down the middle of our page, right there, Earnings Beats Digest, just sign up with your name, email address, hit that subscribe button. We'd love to have you. We do a lot of free events, by the way, throughout the year. Anybody who is subscribed will get an invitation to our free events. So there's that benefit as well. But check that out. We'd love to have you. Now, for today's chart of the day, what I wanted to do is I actually just wanted to show you this summary table on StockCharts. So the way you get here is if you're on your dashboard, you can go over to the left side here under Member Tools, scroll down until you get down to Summary Pages, and right below, 4th line below Summary Pages is Sector Summary. Click on that. It's one of the first things I look at every day when I'm trading. As soon as the market opens, I look to see where leadership at least is starting for the day. But here, this is yesterday's action. We went over this at the open. Utilities, real estate, healthcare. These are 3 defensive groups leading. Financials, they've been beaten down really badly. They're in the 4th spot. And then you come down here at the bottom and look at the 2 highest scooter scores, technology and communication services. Now, I wanted to point out here that I looked at all the sectors and where we stood on Friday, last Friday's close. And then I looked where we closed yesterday to get a sense of what's been going on this week in the market. And this will kind of help to explain that opposite George reference that I made at the beginning. I like to talk about opposite George week when we go into options expiration, because market makers have financial incentive to move prices in one direction or the other. When you've been going down into option expiration, if you go back and you look at the chart of March 2022, you'll see that we were at the bottom of the bear market up to that date, heading into option expiration week. And if you look at the next week or two, the market exploded to the upside out of nowhere. And a lot of bulls back then were getting all excited about the move. Oh, the bear, the pullback's over and we're going back. And I said, might want to be careful, because that move in March was, I thought at the time, still think, was all option related. The groups that led that move were all the groups that led the move to the downside. So anyway, as we look to this week, I want you to look first, the 2 lowest scooters, or 2 of the 3, we have discretionary here, but 2 of the 3 lowest scooters among the major sectors, real estate and financials. I can tell you that, okay, yesterday you can see they were in the top 4. Let me tell you that since Friday, real estate's been the best performing sector, up 2.7% since Friday. Financials, they're the 2nd best. So if I sort this by scooter, and we look down here at the bottom, here's real estate. That's been the best performer of the week. Here's financials. That's been the 2nd best performer so far this week. Then we have industrials here, and then we got consumer staples. We get down to the bottom, the worst performing sector, communication services, down 1.8%. I mean, I talk about this every month. There's a reason why from the 19th to the 25th of every calendar month since 1950, the S&P 500 has an annualized return of almost minus 8%. Now, throughout the entire year, the average annual return on the S&P 500 is plus 9%. But from the 19th to the 25th, since 1950, it annualizes out to minus 8%. It's actually minus 7 and change. 16 percentage points, 17 almost, below the norm. I mean, if you have a 9% average annual return, if every day was created equal, every day should have an annualized return of 9% or thereabouts. But this period, the 19th to the 25th, you might say, well, Tom, it's only 6-7 days. Yeah, but it's out of every month, out of every year for over 7 decades. It's 1/4, roughly, of all trading days since 1950. That's a little bit more impressive. That's like 18 years worth. Can you imagine going through 18 years in the stock market, losing 8% a year? That's the equivalent of what happens from the 19th to the 25th every month. Why? Because you have new money coming in the middle of the month, beginning of the month, middle of the month. So in the middle of the month, you got portfolio managers bidding prices up before the money hits around the 15th. And then you got money flows coming in. The stock market historically goes up from the 11th to the 18th. Annualized return is about 13%, better than the 9%. So when options expire, it's up to market makers to move prices back down, just temporarily. So this is why I warn our members, be careful option expiration week and a couple of days into the following week, because options can be exercised. Market makers can still be on the hook going into the following week. Anyhow, now let's go on to some questions for me. I'm going to try and start making this a regular part of my shows so I can get some questions answered. So recently I had mentioned, I think what I did, I was trying to look, I was using a correlation with Bitcoin, and I'll show you what I was doing. And probably I was looking at a weekly, going back, I don't know, maybe 10 years. And then I would bring up the correlation. And the correlation being how basically the relative strength of technology versus the S&P 500. So let's go ahead and do that. I'll just get rid of volume. I don't need volume. Just trying to get rid of all the noise on the chart. That should help. All right. So essentially what I was doing was I plotted Bitcoin over the last 10 years. And then I plotted the XLK over the S&P 500 versus the S&P 500, just this correlation. So in other words, how well does the direction of Bitcoin correlate to the direction of the relative strength of technology versus the S&P 500? Now, I mean, we've had periods both above the zero line and below, but I think it's clear to me that the majority of time, more time, is spent in the positive side. And maybe to make it even clearer, one thing I like to do is just highlight the periods over plus 0.5, which would be right there. And then essentially do the same thing with below. And I think if we do that, all right. So I think if we do that, you'll see that we're up here in this plus 0.5 or above, many times up near +1. That's perfect positive correlation. We're up here in this blue shaded area much more than we're down here in the red shaded area. So it just tells me that the correlation suggests that there is positive correlation. It's not perfect for sure. And the whole point of doing this was just to say that Bitcoin, when Bitcoin is going up, it's an indication of a risk-on environment. And we know that because for me, there's really nothing that's more risk-on than technology, semiconductors, software, computer hardware, renewable energy. These are all areas that do very well when traders are aggressive, when they're willing to take a lot of risks. That's why in the 10-year bull market, secular bull market that we've had since 2013, technology is the best performer among all the sectors by a wide margin. Why? Because when we're in risk on mode, money pours into technology. So the question that came in from the member was, why can't we just do the correlation with the XLK? Why are we doing it with the S&P 500? And I wanted to go through this whole explanation because we're doing it to see how much risk on Bitcoin is. The XLK could be going up, but it could be going up slower than the S&P 500. In other words, if you're looking at Bitcoin versus technology, they may be going together on an absolute basis, but the relative direction of technology could be going in the opposite direction. If Bitcoin's going up and the S&P 500 is going up and technology is going up, if you just looked at Bitcoin versus technology, you'd say, oh, nice correlation. But what if technology is going up less than the S&P 500, even though it's been going up? It would tell me that there's a little bit of a risk-off environment, and yet Bitcoin's going up. So for me, I like it better showing the correlation versus the relative direction of technology. All right, let's do maybe one more. There was a question that came in. Can you suggest any indicators to follow that might indicate selling a day or 3 days before earnings? And this is what I always talk about in our Q1 earnings sneak preview that I did on Monday. I did a webinar for everybody. That was a public event. The one stock that I said I really liked going into earnings, it was probably my favorite, was Las Vegas Sands. And the reason that I said I liked Las Vegas Sands going in, first, price action's going up. Second, AD line's going up. Third, the group, the gambling stocks are going up. 4, look at LVS, Las Vegas Sands, relative to the gambling index. It's been going up for a year. The only reason, in my mind, the only reason it hasn't broken out to a new 52-week high is we've been consolidating. So anytime you consolidate in a strong group, you're going to start to lose a little bit of relative strength. But we're still very strong in this stock. They reported last night. They beat top and bottom line. And this morning, they are higher by 5%. Now, this is a stock that I wouldn't mind owning. If I was going to own a stock, I want to own a stock like this. To look at a stock maybe that you wouldn't want to own, I would maybe look at SL Green. I think that was one that I really did not like that I talked about. I don't know if they're reporting or will be reporting. Maybe they reported. Maybe that was yesterday. I have to go and take a look when they report. But what I don't like about a stock is when it's trending down, its AD line is horrible, suggesting distribution. Its industry group's bad. The stock's bad relative to its industry group, and the industry group is horrible relative to the S&P 500. That's the type of stock that I would not be holding. First of all, I probably wouldn't own it to begin with, but I certainly wouldn't be holding it into its earnings report. Who knows, what kind of, and maybe if that is earnings, maybe we get a little bit of a dead cat bounce. That's possible. But these are the types of stocks, personally, I would not hold into earnings. All right, speaking of earnings, let's move on to earnings spotlight. Just want to talk about a couple of stocks here pretty quickly. And actually what we'll do is we'll see their reaction. So let's take a look at Tesla. Tesla, you can see down $14 this morning. They did miss top and bottom line. Initially, it didn't look like much of a bad reaction, but overnight things got worse. And you can see the stock now down 8%, certainly weighing on the NASDAQ for sure. Let's see, another one would be IBM. IBM reported. They are up $1.40 right now. Lam Research, key player in the semiconductor space, up almost 1%. As I mentioned, Las Vegas Sands reported last night. Discover reported last night. They're down 1%. And then I'll give you a couple here that reported this morning. Let's see, TSM, another semiconductor, up about 1%. So we got a couple of decent semiconductor reactions. AXP, American Express, down 1%, starting to move up. I think this pullback right here, back to the 20-day moving average, might not be a bad area to enter if you're looking at Amex. It's already gone back, filled gap support, starting to turn back higher. So I think it looks pretty good there. Let's see. How about AT&T? They beat slightly on bottom line. Stock down 5%. It's gotten back up close to resistance. Now it's all the way back down here. AT&T said that stock bores me over the long term. Pays a nice dividend though if you're a dividend player. Just not gonna. I wouldn't look for a whole lot of appreciation. All right, let's take a look now at the three you must see. I'm going to try to go through these pretty quickly here. These are the three worst performers on the S&P yesterday. So I just want to see if there's hope on their chart. Well, I mean, we got gap resistance way up there. We got price support on CDW way down 148. I don't really see a trade here. For me, I would pass. ELV, also a big down move yesterday, down 5%. I think as you get closer, you can see 440 major support. If you test that area, I would be more interested in the stock, just simply from a bounce off support. If you lose the support, I'd get out. Last one, HPE, Hewlett Packard Enterprise. This one just broke down below the moving averages. I don't see a whole lot of support until the 1370 area. So this is another one, personally, I would stay hands off. All right, that is it for me. I appreciate everybody tuning in. Please go over to Earnings Beat, sign up, check our service out. You can do that with a 30-day free trial or sign up for our EB Digest. We'd love to have you. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.